You sat down across from someone. You answered their questions. You were polite. You came prepared. And somewhere in the meeting, they looked at a screen. Just for a moment. Then back at you. The decision had already been made. Not in that room. Not by that person. By a model. Running on data about you that you've never seen. Built by a company you've never heard of. For customers that were never you. You have a score. The question is, who built it? And what did they build it for? Every year, billions of credit decisions are made around the world. Mortgages, car loans, credit cards, rental applications. In some countries, job offers. Each decision traces back to a single number, a 3-digit score, generated by an algorithm, maintained by a private company, never elected, never audited by the people it judges. Most people accept this number the way they accept the weather, as something that simply exists, something neutral, something earned. It is none of those things. The score has a history, a business model, a set of incentives built into its design from the very beginning. And none of those incentives were built around you. Most adults in the US know their credit score. They check it on an app, watch it move up or down, feel relieved when it rises, anxious when it drops. And almost none of them have ever asked who decided what the number means. The assumption is that the score is a neutral reflection of your financial behavior. Pay your bills? It goes up. Miss a payment? It drops. Simple, fair, objective. But objectivity requires a neutral designer, and the credit score has never had one. The algorithm was built by a private company, trained on data collected by 3 other private companies, and sold to lenders who pay for the right to judge you with it. The score feels like a mirror. It was built like a product. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded a company in San Jose. Fair, Isaac and Company. FICO. Their original product was a scoring model sold to lenders, a way to automate the decision of who to lend to. Not who was trustworthy, who was profitable. The distinction matters because trustworthiness and profitability are not the same thing. A person who pays off every debt in full and carries no balance is not the most profitable customer. A person who carries a manageable balance month to month and pays the minimum, generating interest, that person is worth more to a lender. The score was built to identify the second kind of person, not to reward the first. And it has worked exactly as designed for nearly 70 years. Equifax, Experian, TransUnion. 3 private companies collecting the financial data of hundreds of millions of people. They collect this data without your explicit consent for each entry. They store it, they sell it, and they use it to generate reports that can determine whether you get a mortgage, a flat, or a job offer. They are not government agencies. They are not regulated the way banks are regulated. They do not work for you. Their customers are lenders. Their product is your data. You are not the customer of the credit bureau. You are the source material. And they are extraordinarily profitable. Experian generated over $6 billion in revenue last year. Not $1 of that came from helping you borrow. It came from selling information about you to people who want to lend to you, on terms that work for them. FICO publishes the 5 factors that make up your score. They're available on their website. Payment history, 35%. Credit utilization, 30%. Length of credit history, 15%. Credit mix, 10%. New credit inquiries, 10%. They look reasonable. They look objective. Until you examine what each factor is actually rewarding. Payment history rewards people who have been given the opportunity to build a payment record. If you've never had credit, you have no history. Not a good score. No score, which is treated as worse than a bad score in some models. Credit utilization rewards people who have access to large credit limits relative to their balance, which means people who were already offered more score better for using less of it. The score rewards the conditions of having been already trusted. It does not measure how you got there. Credit mix, 10% of your score. This factor rewards you for having multiple types of credit simultaneously. A mortgage, a car loan, a credit card, a personal loan. The model rewards this because carrying multiple products makes you more profitable to more lenders. Not because it makes you more financially responsible. A person who lives debt-free, who pays cash for everything, saves diligently and never borrows, has a lower credit score than a person managing 3 loan products. The system does not reward financial independence. It rewards financial participation. And then there is length of credit history. The longer your credit history, the better your score. Which means young people are penalized for being young. Immigrants are penalized for arriving. People who were financially excluded are penalized for the exclusion itself. The system was built on existing data, and existing data reflected an existing world. The score inherited that world, then automated it. The 3 bureaus collect data from lenders, creditors, and debt collectors. Each one independently. No single source of truth. No mandatory reconciliation. Which means the data feeding your score can differ between bureaus. The same person can have 3 different scores on the same day, sometimes varying by 50 points or more. 50 points can be the difference between a mortgage approval and a mortgage rejection. And you may not know which bureau your lender is using until after the decision is made. In 2013, the Federal Trade Commission published a study. 1 in 5 credit reports contained a material error. Errors significant enough to affect the consumer's score. 1 in 5. The bureaus are not required to proactively notify you if your file contains an error. You have to find it yourself, then dispute it yourself. Through a process that takes months and frequently fails. Under the Fair Credit Reporting Act, you have the right to dispute inaccurate information on your credit report. The Bureau must investigate within 30 days. They contact the original creditor. The creditor verifies the entry. The Bureau accepts the verification. What the law does not require is that the creditor actually check the underlying data. In practice, verification often means the creditor confirms the account number exists, not that the specific entry is accurate. Consumer advocates have documented cases where the same error was re-reported after a successful dispute, sometimes within months. The system is designed to be technically compliant while remaining functionally resistant to correction. You have rights. The rights exist on paper. Exercising them requires navigating a process built by the bureaus for the bureaus. And most people don't have the time, the knowledge, or the documentation to see it through. Everything we've covered so far, the scoring factors, the bureaus, the error rate, the dispute process, these are the problems with a system that is trying to be fair, but falling short. That is not what this is. This is not a fair system with implementation problems. This is a system working exactly as designed. The score was not built to help you access credit on fair terms. It was built to help lenders identify the most profitable customers at the lowest acquisition cost. Every flaw in the system, the bias toward existing credit, the penalization of late starters, the opaque dispute process, these are not bugs. They are the output of a system optimized for someone else's interests. The question was never whether the score was accurate. The question is, accurate for whom? FICO generates revenue by licensing its scoring model to lenders. Every credit pull that uses a FICO score generates a fee. Billions of pulls per year. Billions of fees. The bureaus generate revenue by selling credit reports to lenders and credit monitoring services to consumers, which means they profit twice. Once when they sell your data to the lender evaluating you, and again when they sell you a subscription to monitor the data they're selling. The more central the score becomes to financial life, the more mortgages require it, the more landlords check it, the more employers pull it, the more valuable the bureau's product becomes. Their incentive is not to make the system fairer. Their incentive is to make the system more essential. And it is working. The credit bureau industry is worth over $14 billion. It grows every year. Not because the scoring improves, because the dependency deepens. Her name was Maria. She was 31, a nurse. Single mother of 2. She had never missed a payment, not once. In 11 years of financial life, every bill on time. She applied for a mortgage on a 2-bedroom property in a suburb of Atlanta. She had saved for 4 years for the deposit. She was rejected. The letter cited her credit score, a number generated by a model that had flagged 2 things. A short credit history, because she had avoided debt for most of her 20s, and a thin credit mix, because she had never taken a loan she didn't need. The behaviors the model penalized were financial discipline. She spent 18 months building credit she didn't want, so a model built by a company she had never heard of would allow her to buy a home she had saved for. The system did not reward her diligence. It required her compliance. The most profitable credit customer is not the one who pays everything in full. It is the one who carries a balance, who uses 30% of their limit every month, who makes the minimum payment and revolves the rest, generating interest month after month, year after year. The FICO score is calibrated to reward credit utilization, using credit regularly, maintaining balances, holding multiple products. This is not a coincidence. It is a design choice. made by a company that sells its score to lenders who profit from revolving debt. The score does not reward living within your means. It rewards borrowing within your limits. And the difference between those two things is the interest payment that funds the industry. A system that rewarded people who avoided debt would be a less valuable product to the companies that lend. So the system does not reward that, by design. In 2022, the National Fair Housing Alliance published findings on credit scoring and racial disparity. Black Americans have significantly lower average credit scores than white Americans. The gap persists even when controlling for income. The scoring industry calls this a reflection of historical behavior. What it reflects is historical exclusion. Redlining. The systematic denial of mortgages to black neighborhoods for decades meant entire communities were locked out of the asset that generated wealth and the credit history that validated creditworthiness. The credit score did not create this gap. It inherited it. Then it encoded it into an algorithm presented as objective. A number generated by a model trained on historical data cannot be neutral if the history it was trained on was not neutral. The score calls the outcome a score, not a history, not a system. A score. As if the number existed independently of everything that produced it. The credit score was designed for lending. It operates in lending. It was validated in lending. It is now being used well beyond lending. In 47 US states, employers can legally check a prospective employee's credit report before making a hiring decision. Not their credit score, their report, the full file. The debt, the late payments, the collections. The research connecting credit history to job performance is inconclusive at best. The practice is legal in most jurisdictions. Landlords in the US and UK routinely run credit checks as part of rental applications. A low score can disqualify a tenant regardless of their rental history. Which means a person evicted for the first time, perhaps after a job loss or illness, finds their credit damaged at the exact moment they most urgently need housing. The score follows you into the moments you can least afford a bad result. The credit score is 70 years old. The systems being built on top of it are not. Modern AI risk models in insurance, lending, and employment use the credit score as one input among thousands, not the score itself. The components of the score, the raw bureau data, payment timing, account age, product mix, debt-to-income ratios, combined with purchase behavior, location data, and device signals. The credit score was the first standardized behavioral risk profile. The AI models being built now are the next generation of the same logic. More data, more signals, more precision, less transparency. What FICO built in 1956 as a lending tool has become the foundation of a risk profiling infrastructure that now touches nearly every consequential financial decision a person makes in their life. The score did not stay in its lane. No one asked it to. The credit bureau model is facing a new challenge. 53 million Americans are credit invisible. No score, no file, no history. For decades, this meant they were simply excluded from the formal credit system. Now, the industry has a solution. They call it alternative data. Rent payments, utility bills, phone bill history, bank account cash flow patterns, subscription services, buy now, pay later behavior. The promise is financial inclusion. Bring the credit invisible into the scoring system using data points they already generate. The reality is an expansion of the scoring infrastructure into areas of life that were previously unscored. The solution to being excluded from the score is more scoring, more data, more signals, a more complete picture. The system doesn't offer an exit from the score, it offers a wider door in. Inclusion on the system's terms. The US credit scoring model is not universal. In the UK, the bureaus operate differently. Experian, Equifax and TransUnion all score British consumers. But the scoring ranges differ, the factors are weighted differently, and no single score is used by all lenders. In Germany, the Schufa operates as a near monopoly, a private company holding credit data on 93% of German adults. In Australia, comprehensive credit reporting began only in 2014, meaning positive credit data was not shared between bureaus for most of the country's financial history. And in China, the social credit system that many Western observers have described with alarm shares its fundamental logic with the Western model. Behavior tracked, score assigned, access determined by the number. The architecture differs, the ambition is the same. A scored population is a manageable population. In every system that has tried it, the score expands. It never contracts. If the credit score were redesigned from the ground up today, with the explicit goal of accurately measuring credit worthiness rather than profitability, it would look different. It would not penalize thin files. It would not reward carrying multiple debt products. It would not inherit the racial wealth gap as a design input. The industry knows this. The research exists. The alternative models exist. They are not being implemented at scale. Because the current model generates $14 billion in annual revenue. And the companies benefiting from it are the companies with the lobbying power to shape the regulation around it. The Consumer Financial Protection Bureau has attempted reforms. The bureaus have litigated against them. The scoring model has survived every major reform effort structurally intact. Not because it is the best model, because it is the most profitable model and the most protected. Every day, millions of credit decisions, millions of score pulls, millions of reports sold. Each one touching a life. A mortgage approved or denied. A rental offered or withdrawn. A job extended or rescinded. An interest rate set a point higher than it needed to be. Most of these decisions feel individual. They are not. They are the output of a system processing hundreds of millions of files, with a consistency no human underwriter could achieve. The scale is the product. The consistency is the product. The removal of discretion from the equation, that is the product. And embedded in that scale, in every output of that system, is the design intention of the people who built it in 1956. Profitable customers, identified efficiently, at low cost. The score has changed. The model has evolved. The purpose has not. You have a score. You have always had a score, even before you knew what it was. And now you know what it was built for, who built it, who profits from it, what it encodes. That knowledge doesn't change the number, but it changes what the number means. The score is not a verdict on your financial character. It is a measurement of how useful you are to a system that was never built for you. Understanding that does not make the system disappear. The bureaus still operate. The model still runs. The score is still pulled every time you apply for something. But you no longer accept it as neutral, as objective, as earned. The meeting you sat in, the one where they glanced at the screen, the decision was already made. Now you know who made it and what they were really deciding. The system is still running. It ran this morning. It will run tomorrow. The question is whether you see it now for what it is.